All right, let's go ahead and get started. Yes, welcome everyone. We have plenty of seats, and we'd like to call the May 26th of the Investment Advisory Committee to order. As we do, I'll ask that you join us for our pledge of allegiance, and I'd also like to open this meeting in honor of, we'll talk about that in a minute. I pledge allegiance
to the flag of the United States of America and to the republic for which it stands, one nation under God, indivisible, with liberty and justice for all.
Our salute to our North Carolina flag. I salute the flag of the North Carolina and pledge to the old North State love, loyalty, and faith. Thank you all. We'll jump right into our performance update. We, as you know, have a call the roll, then we'll approve the minutes. All right, call the roll.
Good morning. This is Ben Garner, General Counsel. We'll first call the roll, make sure we have a quorum. So, Mr. Anarella?
Here.
Right. Mr. Brewer? Mr. Coakley?
He said he wasn't coming.
Okay, he wasn't coming. Okay. Mr. Mevin?
Here, can you hear me?
Yes, sir. Thank you. Mr. Patterson?
Non-virtually here.
All right. And Treasurer Fuller? Here. All right. So you do have a quorum.
You have some other comments?
Yes, sir. So a couple of comments. We only have one person calling in. So just for those, well, Mr. Mevin, if you'll keep yourself muted until it's time to speak. One thing to note for the people on site, this is a new sound system with new microphones, so it catches everything that's said. So we'll want to minimize crosstalk just one at a time. So please identify yourself, especially Mr. Mevin, if you're making or seconding a motion. And if you have to leave, please let us know. And then when you rejoin, please let us know. And then we'll go ahead and call a roll. We'll do voting on the minutes by roll call. For anyone else who's calling in, the meeting's agenda is available for public review at the Treasurer's website, nctreasurer.com, at the Investment Management Division page. And if it hasn't happened, for a while, but if we lose the phone line connection altogether, we'll be in recess, and then we'll reconvene, and we'll have a notice on the website. Any questions? Okay.
Just want to make sure you realize I was on.
It's Lance.
That's Lance.
That's Lance.
Oh, Mr. Brewer.
Yeah. Let's get my audio working. Thanks, guys.
All right, thank you. All right.
What sound system?
Yeah. All right. So please mute your phone if you're not speaking, and go ahead and approve the minutes.
I'll make a motion to approve the minutes. Second.
Motion being made in a second. Any further discussion about the meeting minutes? Hearing none, all those in favor say aye.
Aye.
And was it
Aye.
okay. And opposed, no? The ayes have it. So thank you very much. We'll now go into our performance update.
Morning. Good to see a couple of you in person with us, finally after a long wait for all of us. So looking at the markets for the first quarter, really the story we had a surge in vaccinations, obviously, and a lot of economic stimulus announced that helped push equity markets higher domestically and globally in the first quarter. We saw value outperform growth. We saw small cap outpace large cap, which we haven't really seen much in a while. And the energy sector in particular was strong as we saw oil prices rebound, anticipation of things kind of resuming to whatever the new normal may be. Fixed income markets on the flip side were pressured as concerns over that future growth and inflation drove treasury yields higher, resulting in the worst quarter for investment grade fixed income returns since the early 80s section. We saw the 5-year up about 58 basis points, the 10-year and the 30-year up 70 to 80 basis points. So a fairly material move within a quarter for the markets there. Since then, we've seen treasury stabilize. Yields are actually about 15 to 20 basis points lower than where they ended last quarter. The Fed continues to stay the course in their lower for longer mode, as as they've been quoted as saying, and they're continue to see near-term inflation as transitory at this point. And if you look at the latest dot plots from the Fed, it shows only a few members really seeing any potential increase even by the end of 2022. So they appear to largely be on the sidelines with no real changes in their purchases at this point. On the corporate bond side, they still had negative returns, but outperformed treasuries as we saw spreads tighten a little more back to the historically low levels we had pre-pandemic. And then on the flip side, if we go up the risk spectrum a little bit, high yield actually had more spread tightening than IG, of course, what we saw in the equity markets, and high yield actually managed to produce a small positive return. So that's a quick glance at what we saw in the first quarter.
All right, good morning, everybody. It's great to see a few of you in person. Moving to slide 7, the assets under management slide. The total AUM as of March 31st was 159 billion, which is another new all-time high. It's up about 2.6 billion from the previous quarter. The majority of that increase was due to the appreciation of the NCRS portfolio, the pension plan, which was up about 1.5 billion. Moving to the next slide, it's our asset allocation as of March 31st. No major changes here in the portfolio positioning from the last time we talked. Growth continues to be underweight, currently underweight about 8.4%, with the majority of that coming from public equity, followed by slight underweights to the other 3 growth portfolios. The overweight to rates and liquidity is 9.8%, with pretty much all of that coming from the pension cash portfolio. And our IG fixed income portfolio is right at target at the moment. 1.3% underweight to inflation sensitive and diversifiers, with the majority of that coming from our inflation sensitive portfolio. And our multi-strat is right close to its target, so it's a neutral versus our policy target. Moving to the next slide, which is a more recent snapshot of where we are. Again, no major changes in terms of over and underweight since the end of the quarter. I guess the biggest news here is market values continue to move up. Equity markets move quite a bit higher in April, and May's been roughly flat. But you can see the NCRS market value is north of $118 billion, which again is another all-time high. So continue to see asset prices moving, which certainly benefits the plan in total. Moving to the next slide, which is the net portfolio return versus our benchmarks. The portfolio was up 1.7% for the quarter. As Jeff talked about, equity markets rallied. So equity markets were up pretty significantly in Q1, but our IG fixed income portfolio had a negative return with as rates rose as well. So overall, portfolio was up 1.7%. The 1-year return was 21%, which on an absolute basis is very strong, as you can see. It's the highest 1-year return the portfolio has had in more than a decade. So since the financial crisis of 2009-10 timeframe, where we had a strong rebound from that. Looking at longer term performance, you can see the portfolio has exceeded our new actuarial rate of return of 6.5% for all time periods, except for the 15-year, which is just below that at 6.42%. Turning to relative performance, you can see for Q1, the portfolio slightly underperformed the implementation benchmark by 36 basis points. For the 1 year, you can see it's a larger underperformance by about 4% due to the strong rebound in equity markets, followed by following the large drawdown in Q1 of last year. So as you guys know, in kind of our conservative positioning with more cash in the portfolio, we've underperformed as markets rallied significantly. You can see over the longer term time periods, we're still showing strong relative performance versus the implementation benchmark for all time periods over the 1 year. So you can see we're right at or above our implementation benchmark for all the other time periods that we show.
Christopher, let me add for the committee that in this room with another board, which is the actual retirement system board, the teasers and the elders board, we recently lowered the assumed rate of return on this pension plan to 6.5%. And as our guests know, a lot of states talk about lowering this assumed rate of return because most states, because of 9/11 and the great financial crisis, have not achieved these returns for over 20 years on average. These aren't political or emotional statements, they're mathematical statements. And a lot of states talk about doing this and actually do it. They don't fund the plans. So it's no use to say that you're lowering your assumed rate of return if you're not going to fund it. And thanks to some members of this board, as well as obviously the voting board, the teasers, the elders, they voted to lower the assumed rate of return to 6.5%. And I'm only the second treasurer to ever lower the assumed rate of return in 61 years. And reason is that anytime that you lower the assumed rate of return, there's two things that happen instantly. Number one is the fundedness of the plan falls, and no treasurer ever wants to be associated with a plan that's fundedness is limited. And secondly, it requires the funders, which in our case are the General Assembly of the state of North Carolina and the local governments, the counties and cities, to put in more money. So I just wanted to say that it's really gratifying for the first time since I've ever been looking at these charts, which is a long time, that we now have an assumed rate of return that mirrors what our 20-year average is. Comment on that.
Yeah, I mean, I think the only thing I'd add is, obviously the actual rate of return is not just, looking back and hitting that is a great achievement, but it's really forward looking, right? In terms of being able to achieve those returns in the medium and long term for the portfolio. So that's also where rates are now. We've talked about the challenges of going forward and being able to hit what are, the 7%, which we used to have, or a lot of plans are still at 7.25%, 7.5%. It just becomes increasingly challenging in this really, really low rate environment to be able to do that. So I think it's both. You have to look at both in terms of what we think we can do going forward. So that's the only thing else I'd add. So taking a look at our long-term policy benchmark. So the portfolio trailed the long-term policy benchmark, which, as a reminder, is really a low-cost passive approach to investing. If we just put the portfolio in very low-cost investments, you can see what it actually is at the bottom of the chart here. It's essentially equities, treasuries, commodities, and tips. So we think we should be able to beat that, obviously, over the long term, given all the other investments that the portfolio is comprised of. So in the short term, we've trailed that long-term benchmarks, given the strong equity markets, given strong treasury returns that we've seen over the last couple of years. But if you look at the longer-term performance, the portfolio has outperformed that benchmark in most of the longer-term time periods. Taking a quick look at Q2. So as I mentioned earlier, equity markets rallied in April, fairly flat in May. Portfolio is up about 2% in Q2 and up roughly 4% calendar year to date through really the present. Turning to the next slide. So the growth of a dollar chart we show every time. No major changes here. This compares our portfolio versus the implementation benchmark and versus our long-term policy benchmark. And over the long term, tough to see, get all the way up to the right there. But the orange line is the portfolio, and it has outperformed both our benchmarks since really the inception of our returns that we had back in 1998. Moving to the next slide. Same chart, just two different time periods, and we also put our alternatives portfolio just to see how that compares to the portfolio as a whole. And as you can see on the 5-year basis, the alternatives portfolio is trailing both the pension plan and the long-term policy benchmark due to the really more the timing lag. It's taken longer for that part of the portfolio to rebound, where the public markets rebounded extremely quickly, as we all know, during the last 3 quarters of last year. We are seeing extremely strong returns in some of our asset classes, particularly private equity, which I'm sure you'll see in a little bit over the last year. And a lot of the other asset classes are coming back as well. And obviously, we're going to be talking about real estate in a bit as well. If you look at the longer term time period, the 10-year, you can see the alternatives is above both the pension plan and the long-term policy benchmark, just kind of showing that it has been adding value over the long term. Moving to slide 13. This is the contribution to total plan return for the 1 year ending March 31st. So this chart shows how each asset class contributes to the total plan, both in terms of returns and in terms of earnings. So the right side of the chart shows in terms of percentages, in terms of the 21% return that the portfolio earned for the 1 year. The left side converts that to plan earnings. So as you can see, strong 1 year return, 21%, that equates to roughly $22.6 billion of earnings for the portfolio, and the vast majority of that was driven by public equity. As you know, our public equity return was 60% for the 1 year ending March 31st. Obviously, that's coming off of the large drawdown we saw at the end of Q1 last year, but still it's an extremely strong return, which drove the majority of these earnings. So public equity drove almost $19 billion worth of earnings last year, followed by, as I mentioned, strong private equity returns. That drove 1.6 billion, obviously a much smaller allocation to the portfolio, so it doesn't have quite as big of an effect as public equity. And then also strong returns from our opportunistic fixed income portfolio. Moving to the attribution slides on slide 14. So this shows the value add that the portfolio's had versus the benchmark, so any excess return versus the benchmark, and breaks that down into selection effect and allocation effect. So top left, you can see, as I mentioned earlier, the portfolio underperformed our implementation benchmark by 4.76%. And on the right side, you can see that 4.76 broken down into selection and allocation effect. And just a reminder, what that means is selection effect is how each asset class performed versus its individual benchmark. And the allocation effect is how the over and under weights versus the policy targets affected the portfolio. So as you can see in the top right, selection effect was still very strong. We still had strong relative performance, particularly in public equity and investment grade fixed income. But the allocation effect hurt us given the conservative portfolio positioning with an underweight to public equity and overweight to cash and IG fixed income. So moving to the next slide, this is the 3-year, same attribution chart. So basically, portfolio was right in line with the benchmark for the 3-year basis. I think we outperformed by 2 basis points. So looking at the allocation, the attribution of that in the top right, excuse me, you can see the selection effect again was extremely strong, and the allocation effect had a negative impact there, but basically washed each other out for a neutral sort of excess return versus the benchmark. On a 5-year basis, similar story. Value add was there where we did outperform over the longer term, as I mentioned, about 40 basis points on average over the last 5 years. Again, driven mainly by selection effect, with the allocation effect having a negative effect versus the excess return. Moving on to the next slide. Yeah, so the next few slides kind of show some of the risk metrics we track on a regular basis. So this shows several different risk metrics over varying rolling time frames. So I'll just hit a couple of points here. Take a look at the top left chart. That's the rolling volatility of the portfolio. You can see that the portfolio, the volatility decreased significantly in Q1, with the rolling volatility coming down off really close to all-time highs that we talked about for the December time period. And it's now kind of below the 3-year moving average. So we've seen volatility come down in general in Q1, and certainly a lot less volatile than we saw a lot of last year. So you saw that volatility spike significantly last year, but we have seen that come down pretty close to long-term averages. And that's what those dotted lines are there, the long-term averages for the 1 year, the 3 year, and the 5-year rolling time period. So you can see that it's coming down closer to long-term time periods for the portfolio. Similar story on the top right there with the rolling tracking error. As portfolio volatility decreased, we can see that the tracking error also decreased as kind of the swings in the excess return versus our benchmark from month to month haven't been as drastic. So we're seeing that significantly come down as well. Still quite a bit above kind of long-term averages, but we've seen that decrease significantly as well. Moving on to slide 18. So this is some more risk metrics that we track, kind of looking at upside downside capture as well as drawdown, how the portfolio does during drawdowns. We've talked about this a lot over the years, where portfolio is more conservative, so we would expect to not capture as much on the upside, but capture less of the downside, which is a good thing. So that's kind of what the top left of both top charts show, is that, you know, on the downside, you know, we capture less of the downside, which is a good thing. And hopefully we catch most of the upside. The 1-year numbers are a little bit tougher to read, just because, especially with markets like we've had in the last year, which were significantly up. So I think we only had 2 months where the benchmark was actually down in the last 12 months. So that 1-year number can get a little bit skewed based on what's actually happened, given there's not as much data points. But similar story there, where you can see we have pretty strong downside capture, not a strong downside capture, which is a good thing, and fairly strong upside capture, close to 100. And the bottom half of this slide shows just drawdown periods, how the portfolio performs versus our benchmarks, as well as the S&P 500. As we talk about, you know, protecting capital on the downside is one of the most important things that we try to do. And you can see that in every large drawdown, the portfolio outperforms significantly, both the benchmarks as well as the equity markets as a whole. You can see that the significant drawdown we saw at the beginning of last year, you can see that in that chart there, as well as, you know, we had other small periods of it in the last few years as well, where you can see it, you know, it's just how the portfolio is positioned. So we certainly protect the capital on the downside pretty well.
Just a quick question. Between Valentine's and July 4th of last year, from peak to trough, what was the equity drawdown? Was it 20?
Yeah, it was more than that. I mean, it was over 30% at the peak. And the portfolio as a whole lost about $15 billion, and then we've made that up plus another 10 or so since then.
So this chart, this upside down chart, the right there, that showed that our portfolio could have been down billions of dollars more than it ended up being.
Right, if it was in the equity markets, essentially, yeah. So, I mean, the equity market went down significantly. And again, these are monthly period. I believe that's how it runs. It's not daily. So there was such volatility within that time period. It was actually down more than that. It's just not captured in here, given the periodicity of the data points that we track here.
Thank you. Now, the portfolio didn't lose 15 billion, it was down 15 billion.
Correct. All right. Yes. I mean, yeah, I mean, it was down to about 93, a little over 93 billion. And now it's at 118. So, I mean, it's all unrealized, right? But yes, I mean, we track that pretty much every day in terms of where we're at. But it was we talked about before. I mean, it was extremely volatile, and the speed which that happened is almost unprecedented. Not just the downturn, but also how quickly it came back, right? So moving on to the next slide, slide 19. So this is our universe comparison that we show. Just as a reminder, this is our gross of fees, return, and risk versus the BNY Mellon universe, which is the U.S. public funds greater than 20 billion. So our peers, based on what's in the BNY Mellon universe. Again, it's gross of fees. It's the only thing we show gross of fees, and that's due to the fact that the comparison base is gross of fees as well. So as we've talked about pretty much every time, you know, in strong markets, we'll typically lag our peers. We have always had less kind of equity exposure than our peers. We've had more fixed income exposure than our peers. So we do lag in rising equity markets. And obviously the last year, we've seen significant equity returns. So you can see that we've lagged on the return spectrum there. But looking at the bottom part of that chart, the risks, that's the volatility of our returns, we're in the bottom decile essentially for pretty much every time period, which is consistent. Lower risk, obviously lower returns on the upside, better downside capture, which is how, you know, the portfolio has been positioned. Slide 20 is just another measure of universe comparison, looking at the Sharpe ratio. It's essentially a measure that takes both risk and return into account. And we typically rank extremely high here, given our extremely low risk profile versus our peers. You can see the 1 year, not as much, but given the extreme returns in the equity portfolio, in the equity market, that we've seen some of the 1 year statistics we've seen look a little bit odd because of the fact that, we've seen such extreme markets here. So the 1 year Sharpe ratio for everybody's looking pretty good. It's just given the huge returns in public equity for that specific time period. But over the longer time periods, that kind of washes out a bit, and you can see that we're in, close to the top decile, certainly the top quartile for every time period over the 1 year. So moving on to the next slide, liquidity profile. So next few slides hit that. Same thing we show every time. The right side of that chart shows kind of the liquidity allocation as a percentage of market value. The left side shows it in terms of market value. We categorize all of our assets and portfolio within these different liquidity levels. Which you can see on the bottom of that chart. 4 different categories from most liquid to least liquid. And in general, we like to have at least 70% of the portfolio in level 1 liquidity, which is essentially very liquid assets. And currently, we're at about 75%. So we're well within our minimum in terms of what we set for policy guideline. The next slide shows the benefit payments, net benefit payments by calendar year. So we show this every time. Essentially, I just want to make sure everybody understands net benefit. So this is what's actually coming out of the portfolio. We pay a lot more in gross benefits out to the retirees, but we're also contributing to it. A lot of folks are. So these are the net benefits that are going out of the portfolio, and it's been, roughly 2.5 to 3 billion, or close to 3 billion for the last several years. Talked about it before. We've seen a slight downtrend based on kind of the funding policy at the retirement board, but we expect that to level off and then increase probably in the next year or so. So we paid out, I think, almost 2.4 billion in 2020, and we're on pace to do roughly the same in 2021.
We're mailing out checks today, I guess. We're at about a 7.2 billion run rate right now on gross benefits per year, which is twice as much as the state debt. Put that in context.
Large number. All right, moving on to the alternatives liquidity profile slide. So this shows each of our alternative asset classes and the cash flows for that for the prior 12 months. The top is in absolute terms, the bottom is an average, monthly average. You can see, if you look just at the top right there, see the total. We continue to be cash flow positive with our alternatives, getting more money back than sending out. We got a net close to $600 million for the prior 12 months ending March 31st. And we've actually seen significant amount coming back in Q1. I think we were net about 800 million in Q1 alone, where we're seeing a lot of realizations in a lot of these asset classes. And we are seeing a lot of that coming back to us. So we continue to be cash flow positive there as we constantly monitor that part of the portfolio as well. So the last slide I'll hit on, and I'll turn it back over to Jeff. So this is our valuation lag profile slide. So this shows how each part of the portfolio is valued and on what kind of lag time frame. We've talked about how a lot of the less liquid assets, a lot of the private assets are enclosed in structures that are valued quarterly on a 1 to 3 month lag. So you see some of that in the returns. You'll see some of that lag as well, where the public markets are daily and we get those returns immediately. Some of the private assets are lagged, so it rolls in a little bit later. So you have a delay in some of those returns. So taking a look here, the top half of the chart shows each asset class and what their valuation lag is. The blue is daily valued. The orange and gray are monthly valued. The orange is with no lag. The gray is with a 1 month lag, and then the yellow is quarterly lagged with typically a 1 to 3 month lag. So you can see about 75% of the portfolio, a little bit north of that, is valued on a daily basis. And another 8% is monthly. So about 83% is at least monthly, and then the other 17% of the portfolio is valued on a quarterly basis. So turn it back over to Jeff.
Look forward to slide 25, the asset class net of fee performance. Just touching a couple of things here really on the 1-year number. Chris already touched on the public equity. That 60% number is still staggering to see on the page. Private equity also strong at almost 30%. Thinking about private versus public, as we touched on the other slide, there's that timing nature that kind of makes thinking about that 1-year number different. When we look across the slides there on 3s, 5s, 10s, you see the real value add private. Look at those return numbers relative to public for us over time. And then opportunistic fixed income also did well at 17%. On the weaker side of things, the other side, we had non-core real estate slightly negative. IG fixed income was just below 1%, which actually the benchmark there was negative, but because of the positioning we talked about before with duration or credit and everything, we actually were able to still have a positive return for the year in the asset class, and inflation sensitive right around 3%. So the clear standout, as we said earlier, was the equity markets. Moving forward to slide 26, our heat map we kind of show over time here. I don't really have any terribly insightful observations here. If we look at 2021 on the far right column, the obvious thing we see stand out is we see the growth assets up top, and we see the low risk assets kind of near the bottom of the slide, as you would expect in the market that we've had here, certainly quarter to date in that far right column. Moving forward to slide 27, our new incremental and unfunded commitments. Only one new item on here, which is under the opportunistic fixed income bucket. That was $100 million back in February. And then on the right side, we have our unfunded commitments. Peek at those, and not a real material change here from when we sat down from last quarter, only down roughly about 30 million, so standing at 5.1 billion. So not a material change. And we'll see the trend on that on the next page that shows our private asset class commitments. And if you remember, we added the dark blue line in there, the uncalled as a percentage of total market value for the first time in the last meeting. So you can see the 5.1 as a whole there and kind of how dramatically we've come down from back in 15, 16 timeframe. And the 4.45 as a percentage of total market value is our low mark since 05, 06. Last quarter, that number was right around 4.5, somewhere around there. So continue to see that trending down in the private markets as far as unfunded. On the asset allocation history, nothing new on the trend lines here, as Chris touched on earlier. And that just breaks down our asset allocation over time versus the various areas. And then on slide 30, our exited investments, we do have a couple of new items on here since our last meeting. On the public equity side, Marshall Wace, and on the opportunistic fixed income side, Anchorage. Those are both redemptions that were at the end of the quarter. And finally, on our top 20 investment managers, on slide 31, up top are our two internal fixed income and public equity as well. And that number now is up to 52.5% cumulative. So we had touched on before last year, we've been at roughly half, largely due to growth in the equity markets that we've seen pick up there. So kind of our high mark there that we've had as far as the percentage of the assets that we manage internally. And all the other names on the list, there's no changes since we had the last quarter as far as the folks that are on there that are managing money for us on the external side. That's it for the performance recap. And I'd be glad to take any questions from the committee on that. Any questions?
Well, since up here, I'm going to have to ask some questions.
Absolutely.
So the redemptions, they were voluntary redemptions, or?
I'll let the two asset classes speak on that more.
Yeah,
John Anarella. Do you want us to say who we are? We ask
It helps for those who are calling in. So
John Anarella.
All right, this is Rhonda Smith. The redemption in the public equity was voluntary. It was actually a small allocation. What you see that was redeemed was all that the total allocation of Marshall Wace was. Not enough really to move the needle in the portfolio. And as research costs increased for Marshall Wace, it presented an issue of, do we pay out more than we're seeing coming in return? The manager did well, did as intended in the portfolio, just not enough allocated to it to move it.
Ron, you want to touch on your redemption there?
Yeah, the redemption was consistent with how we manage our capital for the team. You know, we like to have high conviction managers be the highest allocation to the portfolio. And when a manager is no longer at the highest conviction level, we try to make our allocation decisions consistent with that. And that's probably all I want to say, given that this is a public forum, especially we still continue to have money with the manager. The manager's done a great job over the life of the manager. Anchorage is one of the leading hedge fund managers out there. Year to date, they're probably up north of 12% double-digit returns. So in terms of performance for the plan, they've done well, but we'd like to manage capital with conviction around other things. And so our due diligence has led us to reorder the deck relative to conviction.
Yeah, so just to be clear, that it wasn't a full redemption for that portfolio, it was just a partial redemption for the Anchorage.
I have two more. Where are we if our actuarial rate return is 6.5? Where are we? Are we on the absolute low end now relative to all our peers?
We're on the lower side, we're not on the low end. Did see that recently. A lot of the peers have been doing that, but not nearly as much as we did typically. Most of our peers, I think, are still around 7. But we're definitely on the low end. We're not the lowest, but we're on the low end in terms of that.
And I would add that one state, for example, and I don't want to, slightly north and west of where we are, they lowered their assumed rate of return to 5.5%. They don't fund it. So, lowering it and funding it are way two different things. So we try to lower it and fund it, but we don't lower it unless we can fund it.
And my last question, Jeff, is so how are you positioning going forward in fixed income?
We're still short relative duration, as much as we have been actually. And we're still slightly overweight credit. Don't really see these screaming value necessarily in IG, but not really concerned about the risk side of those things. I don't see that materially changing. The money that we had, I think we talked about this in the last quarter, the money that we had moved in, we had the dislocation and spreads went out, is all back out and a little more on it. So we've kind of replenished that 90-10 split we had of the cash side of part of core fixed income. It's actually over 10% now, so we've kind of pulled that all back out, credit side on it, but still remain short duration as much as we actually have been policy wise on that.
We
still not optimistic. Still not optimistic on fixed income at all.
We're talking about 6-7 years now.
Yeah.
I will say that this staff was fully geared up between St. Patrick's and July 4th of last year to take advantage of dislocations and put a few $100 million to work, maybe even over $1 billion.
$1 billion.
And then somebody showed up to compete against us, which was the Federal Reserve.
Yeah, if that hadn't ruined our party, we were having
We were putting hundreds of millions of dollars of work at 1,000 basis points over the spread. I mean, well, all that we could handle. And then all of a sudden, as our guests know, that all that ended. Any other questions?
Well, we'll touch on one thing just kind of in the committee on that. We talk about the actuarial return. We've mentioned before about the asset liability study work. So that's something that's in process.
Yep, we're in the middle of that process
Currently,
now.
so it'll be a great check-in point because we haven't done one of those since we've had to change an actual return. So obviously the other part of that wraps into it is the whole asset allocation, look at things with that. So more to come for the committee on that, but that work is in process right now.
Any other questions? Before we introduce our guests, I just want to take an opportunity to thank all of you who not only made this report possible, but all the work that's gone into this report, and especially those that made the meeting itself happen. Many of you know, and our guests may know, there's something that we, all of us participate in called CEM benchmark. And to show you This is where I spent most of my school career, in the 0 percentile. This is a benchmark of how efficiently we run our plan. There's only 3 things that can happen in this plan. Employees contribute, the employee group agency contributes, and then the plan has to make money net of expenses. This is the net of expenses part. So hats off to everybody in this room and those in the IMD staff who are listening, because this is all attributed to you.
I think for anybody joining us on the phone, that more information on that CM study was presented in 2 meetings ago, I believe it was.
Yeah, November.
So if you want any more material on that cost structure where we are, that's in some meeting materials from 2 meetings ago.
And lastly is, I think Ty and Ron presented this to me the other day. It's as we hear John come before us and welcome, and we're really glad you're here. There's just 3 charts here that are stunning. The first chart is that 75% of the bonds in the world are now trading at below 2%. 75% of the bonds in the world are trading. Ty, you correct me on this. Mess it up.
This sovereign debt or all debt?
That's global, yeah. I think that's Torsten Slack from Apollo, I believe.
Yes.
I think he.
I wasn't going to mention their name in the presence.
Oh, sorry.
So it's like the Bertans and the Civitans, man. You just don't want to mix them up. I'm sure they partner on some things. Secondly, the spreads, the credit spreads are back to pre-pandemic levels. So when we were all dressed up, and this was actually a song in the 70s, all dressed up and no place to go. When we were all dressed up and we end up with no place to go, that's where we were pouring capital and all this spiked up. Lastly, yield to worst are now at record lows, and bankruptcies are back down to pre-pandemic lows. So it's a difficult environment to invest in. But fortunately, we're honored to have John Gray and Mary Lynn here from Blackstone. John is the newly appointed Chief Executive Officer of Blackstone. Is that correct?
Still the president and COO, have been the last 3 years, so I can't take that title.
I've met John on maybe a half a dozen occasions, and I'll introduce him as a husband first, a father second, a business person third, and a philanthropist fourth. And I think that's a fair description. And if you read John's bio and his started out this very small firm as an analyst called Blackstone. And a little bit of history is that his father or uncle owned a company in West Chicago that was also ironically called Blackstone. And so we're excited that you're here to give us an update of things that are going on in your world, and you and Mike, come up and have a seat.
Okay, great. Thank you. Thank you for that nice introduction. It's great to be here.
And oh, by the way, we're the first
First pension fund meeting in 15 months. So if I'm rusty, well, forgive me. I was saying, with Mary Lynn, we were talking about how excited I was to come to this meeting, because we've been all trapped in our pandemic world, and the idea that we can present and see a very important client is a great honor. So I start there. I'm excited to be here. We do appreciate the opportunity to manage capital for the state of North Carolina. On a personal note, I spent a bunch of time down here because my daughter graduated last year from Duke. Love this area. Unfortunately, there was no graduation ceremony. We're hoping sometime in the next year there will be. As a firm, we have 4,500 employees across different portfolio companies. We own 18 apartment complexes, almost 6,000 units, 10 million square feet of logistics. We own the High Point Furniture Showroom business in our IMC business, and the Great Wolf Resort in Concord, North Carolina. So we've got a lot of roots down here. I also want to thank the treasurer and Troy for committing to our 9th opportunistic real estate fund about, I don't know, 18 months ago, 2 years ago, which is up about 22% net. So that's been a good investment despite the pandemic. What I thought I'd do today is give you a quick update on the firm, talk about the investment and market environment, and then maybe touch on real estate because that's where you have the greatest exposure with us. And then obviously, I'd love to have a dialogue with all of you, answer whatever questions you'd like. Starting with Blackstone, the firm, the good news is we've never been stronger as a firm. We today manage $650 billion of assets. We're the largest alternative asset manager in the world. And our business is built on a very simple premise, which is deliver great returns to your customers, and they over time will trust you and allocate more capital. And that's what we've been doing in our mainline flagship private equity, real estate private equity, secondaries businesses. We've delivered 15% net now for decades. And that's really been the key to the firm's success. And our clients have responded by allocating more capital to us. So we had inflows of more than $30 billion in the first quarter, and we expect this year to have over $100 billion, which will be the 5th year at that sort of size and reflects great confidence. And interestingly, on alternatives and these targets you guys were talking about, all the clients in the world are facing the same challenge, which is they were set up in a world with targets of 7 to 7.5%, and the 10-year treasury was 6%. And today the 10-year sits at 1.5%. And so it has obviously led to more allocation to alternatives as folks have made a choice to trade liquidity to try to seek higher returns, and that's obviously benefited our business. Overall, as a firm, our financial health is very good. We have a market cap of $110 billion. And at the firm level, we have no net debt. So we think of ourselves as a fortress so we can ride through whatever storm comes along as we manage our capital. What do we focus on at the firm? And I think this is really important. I think about it as my main job, which is how do we protect and preserve this franchise that we've built up now over 35 years? And the first thing we focus on, which has been under a lot of pressure, obviously, the last 12 months, is culture. How do you keep people connected in an environment where they, for much of that, were physically apart? And if you think about our business, we don't have the formula to Coca-Cola, right? What we have is a bunch of very talented, driven people who are connected by culture. And so we've spent a lot of time thinking about how do we keep ourselves connected? How do we maintain that culture? And so every Monday since the pandemic started, we started something called Blackstone TV, which is we have our folks around the globe tune into a Zoom. We talk about what's happening in the investment environment. We talk about what's happening in markets, how we're deploying capital, how we're giving back to communities. And we have a photo contest to show a little bit of humanity. 2 weeks ago, Byron Wayne won our contest on high school photos with his 1950 graduation picture from Senn High School. But there have been some funny pictures along the way, particularly during the pandemic.
Not looking different, doesn't it? Really?
No, Byron's amazing. Amazing. Keeps going into
I didn't mean
his
amazing.
mid-80s.
What? I didn't mean amazing. I just said it didn't look any different.
Yeah, exactly. So that's really been important to us, obviously, connecting. The other thing I'd say is we've pushed to get back into the office, I think, faster than others. I went back in July of last year. I started in September. We started encouraging our investment professionals to come back on a voluntary basis. We paid for their transportation. We did contact tracing. And we did twice a week on-site testing, which was pretty different. But we feel like we have an enormous responsibility to our clients, who are mostly teachers, firefighters, police officers, nurses, who have been working in person the entire time. We did make a decision here in the last few weeks where we said everybody who is vaccinated want to be back in the office on the investment side as of June 7th. And so it's exciting now. The governor of New York said we no longer have to wear masks inside if we're vaccinated. And so this week we started having investment committees. We're packed into rooms again. It felt really good. But culture is super important. I would say as part of that, a number of things we've been focused on. Diversity, something that really matters to us. I'd say we've made a lot of progress on the gender front. Our analyst class now, which used to be about 15% women, is close to half. We're making a bunch of very, I think, excellent senior lateral hires in that area. In terms of underrepresented groups, that's an area that we've lacked, but this year, again, we're now making progress in analyst classes. We're focused on this, and we think a diverse group makes the best decisions. I would mention meritocracy has been something that's really important at our firm, that allowing young people, as you described, Treasurer, I started as a kid at my firm 30 years ago and had the opportunity to grow up. And the way you get great talent into an organization is by doing that same thing, giving them that same opportunity. And so that's really important. And then I would add sort of making sure we have nice people. We did an engagement survey over the last few weeks. We really want to make sure our people not only believe they have professional opportunities, the opportunity to earn more, but they like coming to work, because that's really the stickiness that they feel being part of something special and liking the people they work with. Another area I mentioned we spend a lot of time on is our brand and reputation. How we operate, who we partner with, the kind of industries we go into. These are really important. And when we do things operating at the highest standard, we just bought an apartment portfolio in San Diego of over $1 billion, partnered with a nonprofit to focus on housing affordability, committed to spend $100 million to upgrade the portfolio, to improve the service. We want to be seen as good actors. It's important. And we really think that ESG is not in any way a negative. It's actually core to what we do. We invest in companies, help them grow faster. We invest in assets like infrastructure and real estate and help the communities around us. And so in the last year, we've made a number of important announcements. We said that we're going to try to reduce hydrocarbon emissions from any control asset we buy by 15% going forward, which is something we're proud to do. We've said on our portfolio company boards, we want to be 1/3 diverse in terms of the background, gender, so forth of the people on the boards. We've created a career pathways program, which is to say people from underserved communities, how can we get them working at our portfolio companies? And one of the nice things about our scale is we can really have an impact, because unlike stock and bond managers, because we can control assets, if we say this is something important we can do it across many companies and assets across the country and across the world. Our Launchpad program, which we do with our foundation, which we've done here in North Carolina as well, works with universities now to focus on inclusive entrepreneurship, again, to help people from underserved opportunities become entrepreneurs and build their businesses. The third area that I'd say I spend, and we spend a lot of time focusing on, is obviously investment discipline, because we're an investment business and that is what it's all about. And so we spend a ton of time on focusing on the downside. We have a very rigorous investment committee process that has grown over time: heads up committee, review committee, pre-investment committee, formal investment committee. And it doesn't mean we ensure perfection, but it does reduce errors. And today we're obviously looking for regulatory risk, inflationary pressures, which we'll talk about, in labor and commodities. And the number one risk in every business, which is technological disintermediation, something happening in that business negatively as a result of technology. And so the question I would say is, how are we thinking about investing? You pointed out what a difficult investment environment, and it is very challenging. And I would say what we're doing is we're trying to think about investing thematically. That if you look back at our history, you tend to focus on, should I buy this for 98 or 100? But the reality is not that individual house you were buying, but the neighborhood you were investing in. And shouldn't we as a firm, doesn't matter if we invest in infrastructure or private equity or private credit, real estate, shouldn't we think about what are the right neighborhoods to invest in? And how can we invest thematically in those areas, expressed in different ways? And so I would just highlight for you some of the areas today we're spending a lot of time thematically. The first, probably the most obvious, is the digitalization of everything out there. We're living in a world where there's a great migration underway from sort of a physical world to an online world, and it's affecting almost every industry. So shopping, as we know, we all experienced it in a big way, stuck at home for months, is moving online. It had been for a decade, but now at an accelerated pace. Media is clearly moving online. Our Netflix world, what we can watch or listen to on our mobile devices, Medicine, obviously, is moving that way. Telehealth has gotten a huge boost from the pandemic. All sorts of things like gambling's moving online. I would add payments are moving online. Digital payments will increasingly be done that way. Even things like software, which you think of as technology, but used to be premise-based, are moving online. So the question is, how do you take advantage of that? There are obvious things we do in our private equity and growth equity areas, like investing in Bumble, the online dating business, which has been a terrific investment for our investors, or Ancestry.com, the family history business. Those are the obvious ways to play this. And at times, as you know today, a lot of these on-theme investment trends are priced very high. The question is, are there things you can do one derivative off that benefits from these same mega trends? And I would use real estate as an example. We have been, over the last 11 years, the biggest investor in logistics, in warehouses. Part of the reasons you've seen strong performance, particularly in our funds, is because 40% of what we own in real estate is warehouses. And we're particularly focused on what we call the last mile. So if you think about it, as we go from a physical retail world to an online world, the importance of warehouses within a mile or two of population goes way, way up. And so we've been buying more and more of that, not just in the United States, but in Canada, across Western Europe, across Asia. We just sold a large portfolio very profitably in Australia. And so those mega trends. And so again, what we're looking for is, how is the world changing? How can we capture it? I would throw out as a second example, the shift to greener energies. Put aside wherever you sit on politics, the reality is more and more of our energy sources are going to come from wind, or water, and solar. And so things like battery power become really important. Again, how can you express that in infrastructure, in energy credit, in energy equities? And we've been doing that in all sorts of ways. Obviously, helping to develop solar and wind. You know, those are the logical ways to do some of those things. But there are things that maybe are less intuitive. We just did a deal in our energy fund where we're investing in transmission towers. Normally a pretty boring business. But as you go to a more distributed form of energy, you're going to have lots of places generating sustainable power. You're going to need more of these poles, and so that's something we're doing. And then, as I mentioned, across our portfolio, we're investing a lot, in most cases with favorable returns, by transitioning to some of these greener forms of energy. I would add as a third area, the life sciences revolution. That something incredibly powerful is happening as we take our ability to understand the human genome, your genetic makeup, your DNA, and big data. And what we're going to see in terms of precision medicine, it's not going to be a world where the doctor says, well, maybe you should take this or that. The machine's going to tell us. And when you overlay what's happening with mRNA technology coming out of the pandemic, what's happening in immune therapy, activating our own bodies to fight diseases, there's an explosion of activity in life sciences. There was a nice piece on us today in the Boston Globe about how much we're doing. This has been our most active area of investing over the last 12 months as a firm. It's interesting, you think about a private equity firm, you don't necessarily think about life sciences. But again, in a thematic approach, we've said we see all sorts of opportunity here. We've been the biggest private owner of life science office buildings, places like Cambridge, Mass, South San Francisco, San Diego, the big life sciences hubs. We have been major investors now. We've raised a $4.5 billion life science fund that focuses on phase 3 trial drugs. So drugs that are very promising, not super speculative, pretty far along in the way in the process. These companies need capital. Many of them are oncology, cancer related, some are cardio, some are neurology. And we have a team of expert doctors, research scientists who allow us to evaluate. We've invested in our private equity business in a company called Precision Medicine that runs trials for these drugs. And then in our tactical opportunities area, we invested in a company called Cryoport that moves these drugs from manufacturing to the patients using very advanced technology, cold storage. So again, think about things thematically and express it across the firm. Now, not every one of these big trends is technology driven. Some are demographic. So let's use aging populations. All around the world, in the developed world, certainly in the US, Western Europe, and Japan, But even now in many of the emerging market countries, there's aging populations. That has all sorts of implications for physical assets, things in the virtual world. How do you invest in that? Global travel, something I'll talk about in a little bit, obviously has been interrupted by the pandemic, but air travel has grown by 5% a year for 50 years globally. I don't believe that's coming to an end. That's an area we like to invest behind. The rising middle class in China and India. These places are seeing an increased quality, increased incomes. As a result, they're going to do a lot of things we do. So in a place like India, we've been investing very actively around consumer finance, around education, tutoring and mentoring businesses. We've actually invested, it's one of the few spots in the world we've done a lot in retail because there's limited organized retail. We bought a student housing business in the UK about a year and a half ago. Our timing was not perfect, although I think, and you'd say, well, why is that related to rising middle class in China and India? Well, the student population is coming from these places who want British educations. And so again, it's what is the big trend? How can I capture this? And that's how we're thinking about it. And I would throw alternatives in as a smaller size, but another big mega trend. So in alternatives, we're seeing this flow we've talked about. So we invest in secondaries because there's a lot of inefficiency in the alternative markets if you decide to sell your positions. We invest in leverage loans because the private credit market pays higher spreads than the high yield market, even though leverage loans are senior to high yield. And we've invested in stakes, buying interests in other general partners in our business because of the growth of alternatives. So now I'll go from sort of the firm and how we're thinking about the world and talk a little bit, I guess, specifically on the economy. And what I would say is we are at a very interesting moment. This meeting sort of captures it in the sense is we're moving from, if you think about the economy, it is a flowing river. That river has been blocked by the dam of COVID. And so we're moving from that to something that looks much different as a result of the efficacies of these vaccines. And as this river starts to flow, the force is going to exceed, in my opinion, most people's expectations. And the reason why is there are a few tributaries coming in with a lot of additional force here. One is enormous consumer savings, right? We've all been sitting at home. We haven't spent, we haven't bought new clothes, we haven't traveled, we didn't go out to restaurants. And there's $2 trillion in the US now in consumer bank accounts that didn't exist. Second thing is we have really sizable monetary and fiscal stimulus. We can have a debate about have we gone too far, whatever. Let's leave that aside. The reality is enormous stimulus coming through the system. And then the third thing is we've got this global cabin fever. All of us want to get out. We want to go to Vegas. We want to go to Orlando. We want to get together. We want to do that celebration we've held off. And so what we're beginning to see across the economy and our portfolio, which is sizable, is very promising. Jobless claims now are down to new post-COVID lows. Housing starts are back at a 15-year high. They're actually being constrained today, given some of the supply chain constraints that exist. In our portfolio, we own the largest marine terminal or port operator in North America. Last month was the highest volume in the company's history. We own the Cosmopolitan in Vegas, and despite the fact that there have been occupancy caps, slot activity was at record levels. Our overall private equity portfolio in the US had double-digit revenue growth in the first quarter. And that was against a quarter last year that was mostly COVID unaffected. It gives you a sense of broad-based strength there. And looking at health, there was discussion around defaults. We're the largest owner of leveraged loans in our credit business. We have a $75 billion portfolio, 1,500 credits. There were 0 defaults in the first quarter. So credit, being long credit risk, I do think is a very good strategy. In terms of, Q1 and watching what's happening, how we're trying to position ourselves against all of this, I would say we're trying to get as exposed as possible to what we think is a robust recovery. So travel has been the biggest theme, I'd say, over the last 6 months. We've bought hotels in the United States. We committed to buy a company here based in North Carolina. Hopefully we'll buy for the third time extended stay hotels. We've committed to a large portfolio in Japan. We're working on a large deal in Australia. We bought the largest holiday park operator in the UK, and we bought a private aviation business in infrastructure and core private equity called Signature. So if you put your money where your mouth is, we're clearly believing a robust recovery. The question is, what are the risks that exist out there? And I would tell you the biggest risk is inflation. There's no question. CPI was up 4.2% last month, fastest growth since 2008. Core CPI, ex food and energy, had the biggest monthly increase last month since April of 1982. Now, a lot of people will point out it's a reopening, so maybe that's not a surprise. But if you look at some of the month-on-month trends, used cars month-on-month, not year-on-year, up 10%, airfares and lodging up similar amounts. And we're seeing housing costs go up pretty significantly as well. So my expectation, and we've been saying this publicly for some time, is that inflation, as I said, I think the economy will run hotter than most people anticipate. I think inflation will also run hotter than most people anticipate. I think that will put pressure on the long bond. The idea that the 10-year is below where we were going into COVID, despite the fact now we've added several $1 trillion to the system and there have been more added around the world, that doesn't make a ton of sense. So I would anticipate higher inflation, higher rates. I don't dispute the fact that demographics are deflationary, technology is deflationary. All the central banks are very dovish today, but my overall guess would be rates are going to be higher, and so I'm very concerned about owning long duration fixed income. I want to be invested in assets that can generate earnings, cash flow, to outrun what should be a higher rate environment, and in that higher rate environment, we're going to see multiple compression. So if I own a 20-year leased office building that's flat, let's say to the state of North Carolina, that feels like a bond, that feels vulnerable. But if I have something that's shorter duration, let's say an apartment complex, whereas there's inflation in the system, replacement cost goes up, rents move up, I can offset that higher rate, lower multiple environment. What I would say about real estate specifically, because you have significant holdings with us in that area, I would just say that the outcomes we believe will be much more dispersed than they've been historically. If you looked in the past, all of real estate tended to sort of move together. And again, going back to the technological changes, that is leading to a significant amount of dispersion. On the positive end of the spectrum, as I said, logistics, particularly close to population centers, will do well. If you have something way out in the country in a cornfield, I'm more concerned about that because somebody can build something cheaper. But close into population centers, we think the numbers there will continue to get better. I mentioned life sciences. For those reasons, we like that sector. Again, we like studios and film. We've done a bunch in our Core Plus real estate fund where you're invested. We bought in the middle of the crisis last summer one of the largest studio, I think the largest studio collection in Hollywood, based on what's happening in content, of course, which is exploding. We're the biggest owner in that fund of office space in Burbank, California. So we think there's going to be a lot of creation in that area. I would say apartments and housing generally pretty positive. If you really looked at housing construction in the United States since the financial crisis, we've averaged a little over 1 million, which is significantly below what we need to keep up with population growth and obsolescence. We're now seeing coming out of this, particularly in the low rate environment, job creation environment, people are going out, they're looking for homes, new household formations picking up. So we continue to feel good. Obviously, the Sun Belt states outside of urban areas have done much better over the last 12 months. I think you're going to see a recovery in urban areas, which will be helpful. I would, by the way, in general, say your real estate portfolio results, which lagged. Real estate was obviously the eye of the storm. I think you'll start to see very good results in a lot of your real estate here as we go back to the physical world. Hotels have been hurt a lot. Many of them closed for a sustained period of time. Leisure hotels, we're seeing record levels of demand. I think will do extraordinarily well. I think business and convention center hotels will come back. The pressure on hotels and senior living assets, which were hurt in the pandemic, will be on labor costs. And so that's the thing you've got to watch. Office, I think there are some headwinds here as companies are going to think about hybrid models, maybe a little bit less space. I will say that I think there's a danger of recency bias, that people have, they assume they're going to work from home and so forth. I think a lot of companies are going to conclude that they're better together as we have. I think there will be higher vacancy, the markets will be weaker, but I think ultimately office buildings will come back. It will take time. And then retail is the most challenged area, but within retail, I think there's big variations. So if you look at malls, I think that's where there's real headwinds, department stores, movie theaters, apparel, some of the power centers, big format, think Barnes & Noble, Kohl's, I think there's pressure. I think as you move to more grocery anchored convenience, I think that's where you've got a little more protection. The underlying fundamentals will be better. But I'd say wide dispersion overall, assuming rates don't move too quickly, too far. I think real estate, as I said, it's lagged. If you look at the REIT index, it's up in the single digits or mid-single digits, I think, since the crisis, where the S&P is up something like 35 over that period of time. So I think real estate will see a little bit of a pickup. But my overall story would be one of, it's not an easy environment to invest in. I think fixed income at these levels gives me the most caution. Public equities feel fully valued because they've moved a lot. But if you look at the earnings they're going to produce this year, they probably traded about low 20s multiples on next 12 months, which is high by historic standards, but relative to rates, and certainly the dividend yield relative to rates feel a lot better. So I'm more oriented to equities, and I want to own things that can grow to protect myself against what I think will be a higher inflationary, higher rate environment. So that is a very long-winded sort of run of the world, and I'm happy to talk about different geographies, any asset class, whatever anyone here would like to talk about.
We'll start with board members. We'll start with Mike or anyone who's joining us by phone, or Lentz. Do you have any questions for John Gray?
John, this is Lentz. Really appreciate the commentary. That's one of the more thorough explanations and really breaking it down for us laymen. Much appreciated. So really appreciate it.
Thank you.
Not bad for being rusty, huh?
Hey, this is Mike Noden. Thank you again for the presentation as well. You mentioned that you expect rates to rise in the short term. What can you see the 10-year capping out at the end of the year?
So I think I should caveat my comments that I probably would have indicated I thought rates would rise earlier. So like many people, I've been wrong. So I don't want to put myself out there as a rate forecaster. But my instinct, as I said, is we're obviously going to be in an environment of higher inflationary numbers in the short run. The real question is, over time, where do we settle out? My instinct is it'll be higher. Maybe it'll be 100 basis points higher. So I don't know. Rates feels like if they were 2% going in, they would be 2.5 or 3% coming out of this. 103. I would guess higher. So if I was making a guess, I might put a 3 handle on rates, which is a pretty material move. But as I said, I would caveat that by saying I'm not the world's greatest rate forecaster. My comment is just that we've just put so much more money in the system, and there's so much more in terms of sovereign debt being issued around the world that it does feel like at some point rates are going to have to move. And so that's why, and it feels unlikely to me that rates go lower. And so risk return wise, as I said, it orients you towards having a little more growth in your portfolio.
Thank you.
Thank you, John. I live outside of Charlotte, and I think what's happening in our community is indicative of what's happening in a lot of the outer ring urban areas in Sunbelt. Tremendous demand for apartments, housing, single-family homes were up 65% last year. We're ahead of that schedule this year. But the thing that's been most fascinating from my standpoint has been the commercial. And it's your last mile, it seems, that a lot of these spec developers are using. So to give you an example, 5 years ago, there was 0 spec. In our town of Huntersville, we have, if I add up what I just heard last night when I was driving here, we have over 5 million square feet of spec.
Industrial.
Yeah. And is that
John's the
something?
mayor of that town, by the way.
Okay, so he's
It's all
well
because
informed.
of me, but is that what you're seeing in and around, at least the South?
It's a great question. I would say, obviously, a place like Charlotte or suburban Charlotte is much easier to build in, and than it is as you get certainly on the coast and you get to the biggest urban centers. And so, the risk in real estate, of course, is I may be right about the demand picture because we are moving more and more to e-commerce. But if the supply swamps that, then you can, then the returns for the investors in these projects may not be what they expect. I would say the bias would be towards the harder to build areas with larger population centers. We are starting to see a pickup, but if you look at under construction overall warehouses, it's still in the low 2% range nationally. Vacancies in the mid-single digits nationally. So it has not gotten out of hand. So I would say there's more construction here. There would be more construction in a place like Dallas. And it's something to keep your eye on. And so, like any asset class, we've been preaching logistics now for a decade. I've been saying sort of the same thing. Investors, particularly post-pandemic, are moving here. And so I think you do have to watch it. And so where you're more protected is if you're just across the bridge in New Jersey. And so that has real upside, or you're close in Los Angeles. And so I do think as we get deeper into this, there is some risk of overbuilding in warehouses, particularly in lower barrier markets.
John, thank you for your comments and congratulations on your daughter graduating from Duke. And similar question to John, but more on the single family homes. This area, like many parts of the country, there is just no supply. I have real estate agent friends that say you want to be the listing agent if you can find a house to list. But I worry that the very teachers and firefighters and correction workers that we're trying to serve are being so priced out of the market. And if our interest rates go up 100 basis points, that's just going to put more pressure on it. Are we going to have a solution, or are we going to have a bubble? Any predictions on what's going on in the entry-level single-family housing?
Yeah. Well, as I said, if you looked at the data, we've just way underbuilt.
Right. And
then the pandemic compounded things by pushing people out of urban cores. And that created short squeeze. And then you guys have a particular problem, a high-class problem, which is you've got this research triangle. What I didn't comment on in real estate is everywhere you look around the globe, wherever creative technology folks are housed, that's where you're seeing the most economic activity. So in places like Seattle and Cambridge, Mass, Toronto, London, Amsterdam, Scandinavia, Tel Aviv, Bangalore, Shenzhen. So you guys have a tech hub here. You also have low cost of living and low taxes. And then you add the pandemic and the shortage of housing construction, and you create a little bit of the perfect storm. And now you make it really hard to get lumber, labor, all of this, and it creates a short squeeze, which is what you're saying. Some of that I think will alleviate over time, but I would expect that in a way you will continue to be victims of your own success, in the sense that more technology-oriented companies will choose to move down here. You look at even Durham in the 5 years I was spending time with my daughter down here. I mean, the transformation is extraordinary. What's happening? I think that's a trend here and in places like Nashville and Salt Lake City and certainly Austin that's going to continue. So you do have the benefit of less stringent zoning. You can build more, but I think the cost of living in a place like this probably does continue to go up. Not at the rate we're experiencing right now as we reopen, but I think that's a challenge. And, the only countervailing force that will be helpful here is as the big cities reopen, some of these particularly young people, will start to migrate back to the cities. Again, I'm talking about my daughter, but her and her friends were all living with their families in Dallas and Miami and Jacksonville and whatever, and now they're all renting apartments back in New York City. So I think some of the push that's happened out of cities, some of the migration will reverse. But I think the long-term, population trends for states like North Carolina in this particular area are very strong. And I don't see that changing. And I think that will make it more challenging. And so for policymakers thinking about what you do around affordable housing, which is, these are decisions for you and the legislature and stuff, but to say to developers, look, we'll give you zoning density or so forth if you build more homes at a certain price point. In the UK, they do a really nice job on this. You create economic incentives that allow them to build more, because I do think housing in a place like this will become more expensive over time. That would be my instinct. The rate of increase we're seeing right now, it's going to level off. Rates will go up. Some people will move away. Some of the supply constraints will go down. But I think the long-term trend for those of you who are homeowners here, I would say is quite positive.
Questions from staff?
I believe I heard you mention that you have a holding with High Point Furniture Market. That's my hometown.
Oh, good.
And I'm curious, a lot of that, a few people know that High Point was known to be the furniture capital of the world, but a lot of that is kind of moved to China. Where are you seeing that type of manufacturing evolving, and how are you seeing in terms of skilled trade labor kind of coming back to this area?
So interestingly, High Point, even as manufacturing moved offshore, Mexico to China, High Point really remained the furniture showroom, certainly for the United States in this hemisphere. There was a center set up in Las Vegas, and the company we bought owned both of these. So it owned the two big furniture marts. And despite the fact that manufacturing was done in different places, High Point really continued to thrive. I'd say the biggest challenge for High Point has been COVID, obviously not bringing people back together, and now different distribution. And so we're doing more, creating an electronic platform for our folks so that they can see a virtual showroom as well as the physical. I think as the world reopens, you're going to go back to High Point, you're going to go back to Las Vegas. And so I think, though, some portion of that business is moving online. But I think there's, particularly with furniture, going and seeing it matters. It's hard to get the sense of sitting on a sofa virtually. I would say on the manufacturing question, I'm not sure how much of that comes back to the United States, but it's possible that a lot of it, or that a big portion in China, given the events of the last few years and inflationary pressures in China relative to places like Vietnam, may see some of that move. But my expectation for things like textiles and furniture is probably that there won't be as much. There may be some more nearshoring, but I think for a whole variety of reasons, I think it will probably stay mostly outside the United States, is my guess. The interesting thing for the U.S. is, I think the unemployment ranks are going to drop. I think we're going to get back quickly to that 3-ish%. Once people, particularly some of these things, burn off from the government, I think people are going to be back out there looking. So I think job opportunities should be pretty good, but manufacturing and furniture, I'm not certain how much of that comes back.
John, thanks for joining us this morning. Georgia comments around you got to get the buy right, you got to get the theme right, invest in the right neighborhood, et cetera. But over the years, I've witnessed Blackstone increase human capital in its operations team that actually works with the various portfolio companies. I thought you might would have touched on that, and I think that's one of your secret sauces that other private
That's a
equity
great
firms
question.
Yeah.
So part of the business, and a big part of the business, Ron's right, is not just investing and buying things right, not necessarily just selling it. It's what you do when you own these companies. And so we've invested enormous amounts of money in a variety of areas. We hired a woman, Jen Morgan, who was the co-CEO of SAP, which is the largest software company in Germany. And it gives you a sense of how important we view this role. The previous head of our portfolio operations was Dave Calhoun, who's now the CEO of Boeing. And so we really view this as a key function. What I would say in the business has changed is as we've moved to more companies, greater growth orientation, probably less focus on sort of lean manufacturing. We still have that capability, but now a lot around distribution, marketing, technology, human talent to really grow these businesses. How can we be great partners? And so, you know, one of the questions when you look at the returns of private equity is how have you been able to produce these high returns over long periods of time, despite higher fees, obviously. It's because of this ability to add value at these companies, to go in there and work with a management team and help them figure out what's a non-core business, where should they reinvest, how can you improve how they go to market. I would add specifically the area we probably invested the most in the last 3 or 4 years has been data science. And this is a tool that is so helpful for us on the buying of companies and overseeing them once we own. So we have 35 data scientists today. And what do? So what they do with these companies is, you know, oftentimes companies will be very inefficient in how they sell their product. They'll go out and they'll look at a phone book of potential customers. They're sort of spraying around, trying to boil the ocean. With data science, we could say, look, we've noticed that of your 500 customers, 80% of them share these 7 qualities: geography, size of the business, how much they spend in a certain area. We're going to run that through the machine. The machine's going to tell us, okay, go call on these 50 potential clients because they're much more likely to use. We also are using data now to monetize it, always on an anonymized basis, so there are no privacy issues. Some of these companies have really powerful data that various market participants would like, and we're turning that into cash flow for the companies, which is powerful. And then even in things like real estate, which you don't think of as high tech, we're using, there's data scientists on every deal team now. I'll use an example. We were looking after Amazon announced that they were going to, find a new headquarters. There were some buildings in Seattle we looked at. People were very nervous what was going to happen. Our data scientists scraped all the job sites, the LinkedIns of the world, and showed graphically the number of jobs for Seattle proper for Amazon. It was actually up 20% year on year, despite the fact which just showed how much growth there was in Amazon. We went ahead and bought those buildings, very good investments. And the same thing on customer service we do across this. You can pull all this data. And then one of our great advantages at scale now is we control so many businesses that we can utilize that data and have proprietary insights as well. So I would say to us, if you think about investing as pattern recognition, connecting dots, we get to see more dots than anybody else. We're trying to take advantage of that. And then once you own businesses, to have as many resources as possible, tools to be partners. I talked about Whitney Wolfe Herd at Bumble, which is a phenomenal investment. We made 4+ times our money. If you ask Whitney, she said we helped her build out her executive team, assembled a world-class board. Think about how she does some of her online advertising spending, working with our data science team, a whole range of activities. And that's a key element in what we do. It's the same in infrastructure. It's in real estate. We say buy it, fix it, sell it. You've got to be able to do that. So it's one of the things that at scale, I think, gives us an advantage.
The pressure that we're seeing on minimum wage increases, how do you see that? What are your thoughts on that for the economy, and what are your thoughts on that for the profitability of different asset types?
I honestly think the market's probably going to move past the politicians, it feels like today in many markets, which is you saw Bank of America came out at $25 an hour for tellers. Chipotle came out at 17. McDonald's say 15 in many spots, I think they said. I think the market forces in the shortage of labor. Not to get into politics, I think getting low income workers some basic standard of living, I think is appropriate, but it does feel to me that market forces are going to move fairly quickly. I think that is going to put pressure on the low wage businesses. By the way, we're seeing wage pressure in, high-end businesses, Blackstone, financial services, lawyers, accountants, all of these businesses. So up and down the food chain, we're seeing pressure. But the most labor-intensive businesses, this is why I said, hotels, restaurants, physical retail, healthcare, physical healthcare, those businesses, some of which run at fairly low margins, that would be an area of concern. So I think, looking at margins in those areas, if you have a lot of low wage labor and you have thin margins, that's where you could see some underlying credit risk. And the same thing, by the way, on commodities, if you have a business where you have input costs driven by commodities, and yet you can't pass that on to your end users, you could see those businesses squeezed. But it is, I will say, remarkable how much strength we're seeing across businesses. The only businesses that are in trouble today, for the most part, are true buggy whip businesses. It's landline phones, old media, some of the older advertising businesses, some of the physical retailers, some of the E&P companies. By the way, I think traditional energy, even though I said there's going to be this massive shift which is coming, in the near term, traditional energy prices, I think, will go up a bunch, even from here. And that's because there's no longer investment in the space, and now we're going to get this surge of activity. So as you think of investing in equities and credit, these risks should be top of mind. It's what we're looking at, particularly with the labor-intensive businesses. And I think it's not just in the US, I think you'll see similar dynamics, certainly in the UK as well. Continental Europe, which is lagging, is probably a little bit different.
You talked about inflation a little bit as it related to real estate. I wanted to dig into that a little bit more, Glenn. I'll get back a little bit more. Generally, I would view real estate as a good inflation hedge asset. You mentioned 20-year lease, single tenant building, maybe not so much for office, but multifamily more so. But just in general, real estate, is it a good inflation hedge, or would you say it's going to, if there's higher inflation in real estate in general, is going to perform well? And follow up to that is the public markets. What I've seen generally in the past is when there's talk of rates going up, REITs, the public markets, tend to tank, at least in the short term. And would you say that's appropriate, or all of a sudden REITs are on sale when that happens?
Yeah. So two things. On inflation, the positive for real estate is the physical replacement cost goes up. So those developers in your town, John, the cost that they probably thought they put on a piece of paper 6 or 12 months ago are materially higher today. And so by definition, the existing physical stock should be protected. This is why you'd rather own a piece of real estate than a long duration bond in a rising inflationary, rising rate environment. So the general comment is hard assets are good to own in an inflationary environment. But if we go one layer deeper, again, it's the type of hard assets, right? So what you want is assets that can reprice and grow their cash flows in the event as rates come up, potentially cap rates come up or multiples go down, that they have an offsetting growth in cash flows. So the apartments, I think, are the best example, because in a higher inflationary environment, those leases are generally no longer than a year. You're able to reprice, recapture the higher growth, higher inflationary environment. The longer duration the asset is, I think the more vulnerable it is. And then there are these secular trends, as we talked about, physical malls. What does that mean? The pressure on some of the office, traditional office in particular in urban centers, those will be under pressure. What you need is assets where the cash flow can grow sufficiently to offset what will be the higher inflationary, higher rate environment. But overall, I think inflation for hard assets, it's a better neighborhood to be. All assets, obviously, stocks, if we go into a really high inflationary, really high rate environment, there are very few assets, maybe other than gold, or I don't know, maybe digital today, I don't know, that are well positioned for that. But in the sort of choice of assets, I think in an inflationary environment, you definitely want to own hard assets. Now, as to the public markets, what I would say about the public markets is they tend to track private real estate values over long periods of time with enormous volatility. So if you look at private real estate from the bottom in the beginning of 09 to, let's say, just before the pandemic in beginning of 2020, over that 11-year period, real estate didn't really go down, private real estate. There may have been periods of slower growth, but it didn't go down in value. And yet in the public markets, I think there were like 15 times where the public markets went down, real estate markets went down by more than 10%, based on a rate scare, based on this, that, or the other thing. So I do view the public markets as an opportunity to trade around when that gap widens out. So today I would say the public markets probably are inexpensive in real estate relative to some of the activities in the private markets, but that can change. And the public markets have begun to move up now. And so they sometimes trade well through, sometimes below. And so they don't necessarily correlate in the short run, but over time, the correlation is good. So it just looks like some sort of heart monitor around the line. And yeah, I would look at it when it gets really far out of whack, it's an opportunity to take advantage of it. It tends to be within 10 or 15%. Generally, it doesn't go completely out of line. Sometimes the public markets are, when something like COVID happened, they fell super dramatically. The private market shut down. It's hard to say, but they tend to be more forward looking, but they also just tend to have more volatility.
Given your outlook on rates, you mentioned you were more heavily allocated to loans and cautious on IG. What are you finding to do on the credit side? Is it more focused on kind of event-driven distressed opportunities, or are you finding more to do in direct lending, private credit?
So I would say distress, because there's so little. You're basically structurally distressed if you're distressed today. So you're taking real credit risk, lending to the companies. I think the high yield index has something like 3% distress. And if you look at that list, you'd say, wow, these are challenged businesses. So I wouldn't do that. On the other end of the spectrum, investment grade spreads, corporate liquid, spreads are very tight. So I guess I would go to two places. Structured credit spreads have been higher because since 08, 09, those spreads are wider. In many cases, the risks are the same or lower. So I think structured credit, we do a lot of direct structured credit lending now. We've been doing stuff around aircraft, which we think is very interesting. Student loans, the private student loan sector in our TAC ops area, we did that. We think structured credit, I would say, is mispriced. And then non-investment grade performing credit in the private market. I think high yield is pretty tight. And as I said, what I find fascinating is, let's say high yield spreads are 375 over today. Leverage loan spreads are 375 over. The leverage loans are senior in the capital stack. So if somebody said, I got to own fixed income, I would own leverage loans. You can own them very efficiently. You can put no debt on them if you want. You get paid 375 over. You can have a very diversified portfolio. We've now been through two crises in 08, 09, and this one. And these leverage loans in terms of realized losses, there were mark-to-markets, clearly, but realized losses have been very limited. And if you want to even be 1 degree safer, you can buy the senior CLOs. So the AAA CLOs are still at 115 over, well wide of comparable corporate AAA paper or government AAA paper. And when you look at how senior that is, that's a diversified pool that probably runs to like 2.5 times debt to EBITDA. It's almost impossible to come up with a scenario where you have a loss in AAA CLO paper, and yet it trades much wider. So again, structured credit, high yield and non-investment grade, leverage lending, or I would say direct lending. The one thing I'd caution is I'm a little concerned about over-promising how high of returns you can produce in credit, just given the base rate environment. Anything producing much more than 10-ish net, I think is pretty hard. You're taking some level of equity risk to do that today in this kind of rate environment. So I think you can get a nice premium. So I'm floating rate private markets, or in the liquid markets, I'm a structured credit investor.
Do you see any structural or systemic risk associated with the shift from LIBOR to another reference rate with leveraged loans or any other floating rate
No,
instruments?
it's not my area of expertise. What tends to happen in markets based on history is people, there could be some anomalous things, and there could be securities that are left behind, orphaned. There could be some trading opportunities. But when markets move to that new standard, the liquidity is going to move. And as long as everybody moves sort of together, I think it should happen. But I would ask somebody who's more a student of fixed income to know. That's what I'd say.
You mentioned student loans. So the whole concept of student loan forgiveness at the federal level, that kind of story gets a little bit mixed. So, I mean, that can only be done really properly at the federal government level. I mean,
We're investing.
what would happen on the private side?
Yeah. So I don't believe the government has a right to forgive a private contract. Last I read the Constitution, I don't think that's how it works. So the argument would be if you forgave 85% of the market, the public sector market, would it spill over and private sector borrowers say, well, now I don't have to pay? I think the positive and what we've been doing is much higher FICO scores. So the private sector tends to be the portfolio we bought were all people with high FICO scores, basically wealthy people with student loans. So I think that's a category where we think they'll continue to pay. And I think if there's forgiveness, I'm not sure how the federal government's going to come up with the program, but it's a risk factor as you look at this overall. But it was just an example of structured credit where I think it's an interesting area, as long as you realize you're not going to get double-digit returns, but you can get higher returns than you can in liquid securities. And for all of you with your duration, trading in fixed income for some benefit of the private market, higher spread, I think is a worthwhile thing to do.
Any other? Thank you. I am the oldest person in the room, so I was actually pumping gas and working on a gas station during the Arab oil embargo. And it used to take forever to put a gallon of gas, $1 worth of gas in a car. That was 4 gallons of gas when I started pumping gas. And it just took forever for that to get there. And so the guy kept me there underage working because may have heard, but I actually saw this, that you can only buy gas based on if you had an odd or an even number last digit on your license plate. And I sort of had a fairly good memory, and I was seeing the same car come in. They would switch license plates. They just have an old license plate in their house, which people my age used to do all the time, just old license plates. And so they kept bringing the car in every day to get gas. So this is all leading up to maybe a comment or a question. People saw it, inflation. They didn't believe it. People are seeing inflation right now with commodities, labor, lumber, price, everything but the price of capital. So there's only 3 things that drive your business: price of labor, price of material, and the price of capital. So they're seeing major inflations in 2 of those areas. They see it, but I'm not sure they believe it. When it gets ingested, it's hard to get it out. So I just want to know if you had any comment about what it's going to take for people to believe it, and then what that's going to feel like. I think it's a real issue. We've gone so long. We've had certain commodities spike up over time because there was a shortage in this, that, or the other. But we haven't since the 70s, and it was really broken by Paul Volcker and Ronald Reagan in the early 80s. We have not seen now for 40 years periods of high inflation. And the question is, or stagflation. The question is, will people, as they begin to see the price of everything, food products, energy, housing, everything go up,
and they need higher wages start to go up, does it start to change expectations? And I think at the Fed and the administration, they'd say, look, everybody said this after 08, 09. There was a little bit of a spike, but things went back. And that's sort of their base case. I'm a little more cautious. I just think there's been so much stimulus at such a scale that I think there is going to be a higher level of inflation coming out of this. I still, as I said earlier, see technology is highly deflationary and demographics is highly deflationary. And central bank policy is very accommodative, staying around the world, even more so outside the US. But yeah, it is the largest risk that exists. If you wanted to say in a portfolio, what could go wrong, it's that we wake up and genie's sort of out of the bottle, you can't put it back. And people's expectations start to change, rates move up a bunch, valuations come down. The question is, if you have that scenario, where do you want to be? If that's the case, you probably don't want to hold too much cash. You don't want to own a lot of fixed income. You'd like to own businesses whose value, because there's more dollars chasing the value of those real estate assets, infrastructure assets, companies. You'd like to own a portion of that try to outrun this inflation. And I think that is the big risk. And, I don't know, as I said, my base case is we move to a higher level of sustained inflation, but it doesn't go out of hand. We have the spike, but where it settles is higher than before we went into this pandemic. And that puts some valuation pressure, particularly on long duration bonds. But does the risk exist that this could go awry? I think that risk definitely exists.
Thank you, and I apologize for having to leave. Two of the 21 hats I wear are chair of the State Banking Commission and also on something called the Global Transport Board. Well, two people on the Global Transport Board are Frank Holding, the First Citizens, and John Allison, who you're familiar with, he used to run BB&T Truist. And so I had to go out and get my proxy to somebody to sit on that board. So I apologize for leaving. And I just wanted to thank you. I'm glad that Troy and all your team back in New York were able to set this up, and glad for you to join us. And I would just anecdotally say to you, one of the other hats I wear is chair of the Local Government Commission, which regulates issuance of debt over 1,300. All 100 counties, cities, water and sewer districts, airports, universities, and hospitals. And with this flood of stimulus money, we're drowning, as some people have described it. We won the lottery 3 times. That the issuance, we approved the issuance of the bonds in this room. And a lot of people are just going to do pay-go now. They're not going to issue bonds because of the amount of money that they're getting from the stimulus. So I think the supply of municipal bonds could actually decrease, which would be another spread differential when people start looking at tax-free rates versus taxable rates. So anyway, great presentation. We wish you and everybody with Blackstone the greatest degree of success. I wore 2 particular lapel pins today that I often wear, but especially in honor of y'all's visit. One is the one that belonged to Harlan Bowles, who was considered the best state treasurer of the 20th century in the United States. He was the state treasurer.
Was he related to Erskine?
Spelled differently. But people often confuse them. And Erskine's obviously accomplished in so many ways and a great North Carolina. Yeah, North Carolina citizen and confidant and supporter of mine. So I have bonded my relationship with him. But the pen represents loyalty and duty of care, fiduciary responsibilities, and we appreciate how Blackstone internalizes loyalty and duty of care, which are the 2 tenets of our responsibilities here. And it's what all of the staff has responsibility for too, is a culture of loyalty and duty of care. And the second one, obviously, is to honor law enforcement officers who were killed in line of duty. And 3 weeks ago, tomorrow, I was in Boone, North Carolina to attend the funeral of 2 deputies, Ward and Cox, who were killed in line of duty. And it just goes to what you were saying earlier in your opening comments, that we're in the check delivery business, and most of these checks are blessings. But we're also in the check delivery business for things that aren't blessings, and that is for the spouses, the annuitants, the decedents of these law enforcement officers who are killed in line of duty. So I know that you, I know from speaking with you that that's not just where your mind is, but that's also where your heart is. And we appreciate you having that connection with us.
Thank you, Treasurer. It's an honor to be here. Wonderful group. And as I said, it's an honor for us to manage capital for the state of North Carolina. So thank you all so much.
So what's going to happen is Troy and team's going to come up and do a real estate presentation.
I'll stay in the audience.
Yeah, and we have in her honor, we ordered Bojangles today.
I gave him the. Extremely experienced, but genuinely a nice guy, and I think that's part of his secret sauce, is that he's really good at being a good person, and being able to deal with a variety of different folks in a variety of different situations is really what I think sets him apart. Thanks again.
Thank you.
Our team has changed. We have a new analyst on our team, Chris Ward, joined us just a couple weeks ago. We're in the process of filling a portfolio management position right now. Hopefully we'll get someone on board in the next few weeks. But welcome, Chris. Chris has been with the ops team for the past 7 years, so he's not exactly new to the investment department, but he's new to our team. Very happy to have him. Next page, I'm not going to really talk on this right now because John basically touched on most of these sectors, and I don't know that I can do any better job at that than he's already done. So we're going to skip over that. I will say maybe at the bottom, the hotel, retail, we've got those rated as high risk, and I still feel like that's appropriate, but when there's uncertainty, sometimes that uncertainty creates opportunity. And while hotel is very risky and retail might be risky, there may be more opportunity in those sectors now than there has been in the past. Elevated risk for sure, which is why I rated them where they're at. Let's skip straight to page 6 and just talk about how our portfolio is positioned. On the left side of the chart, our legislative cap for real estate is 10%, and our investment policy document, our target is 8%. As of yesterday, I think we were 7.29% of plan. So we're 70, 71 basis points underneath our policy target right now. On the right-hand side, on an absolute dollar basis, we really haven't changed that much in the last 5 years. The fourth quarter of 2016, we were $8.2 billion. Today, we're $8.7 billion. So on a dollar basis, we're actually higher. But we've dropped quite a bit from 9.3 down to 7.3% of plan, mostly due to the denominator effect. Our portfolio has shifted during that time as well. Back in fourth quarter of 2016, we were 55% core, 45% non-core. Today, we're more like 65% core and 35% non-core. The core portfolio is predominantly in separate accounts, and we're for the most part not selling those, and they've been appreciating and doing well. So that on a dollar basis has continued to grow. The non-core portfolio has continued to shrink as money comes back from that portfolio, and the commitments to the non-core portfolio have been fewer. The non-core
we've had a couple different assets that also shifted from non-core to core. Our multifamily portfolio in our separate account with one of our separate account managers starts out in non-core as we build it, and then as it stabilizes, it moves over to core, and that's a total of $1.2 billion right now. So that's also contributed to that shift from non-core to core. Next page. Cash flows. Net distributions in 2020 were $602 million. So far this year, we're about $180 million net distributions. I would project probably for the year we'll be at 600 million or so net distributions by the end. That's the contributions and distributions, as you can see on the chart, of both just trended down. But net last year, this year, and the year before have all been in the $500 to $600 million range. Manager concentration, we talk about this every year. John talked about it a little bit. Craig talks about it all the time, and we want to get the right managers, get the right people on the bus, and we continue to concentrate our portfolio more and more into what we call our high conviction managers. It's even higher than it was last year. Right now, the overall retail portfolio is 90% with those high conviction managers. We have probably 25 or so relationships right now, and we call 11 of those high conviction managers. Managers that we have high conviction will meet or exceed their performance expectations that they advertise to us. The core portfolio, it's even more highly concentrated at about 95%. The 9 core portfolios, I think it was 82% on the high conviction managers. Trending in the right direction, and we hope to continue to add into our high conviction managers like Blackstone. That concentration helps us in a variety of ways. It helps us negotiate better fees. It helps us with transparency, getting more and better information because we're a larger investor with the managers. Next slide, cost efficiency. We continue to move in the right direction on that. You can see from 15, 16 down to 19, we're still moving down. And there's a couple of reasons for that. We're able to negotiate with these concentrations in our managers better fee deals. But it's a percentage of market value, and market value has gone up. So as a percentage of market value, the fees that we pay have gone down. Performance, slide 10. The performance in the 1-year period, it's 210 basis underneath our benchmark. That's primarily driven up, more than 100% of that is driven because of our underweighting to REITs. Our benchmark is 80% private, 20% REITs. Right now we're at about 15.3% REITs, and REITs in that last 12-month period were at a 36% return. So just because of the extremely strong return in the 1-year period for REITs and the fact that we were underweight, even though we outperformed, our REITs outperformed their benchmark and our private core underperformed, but by just a little bit, that drove this underperformance to our benchmark in the 1-year period. Generally, our REITs, our core portfolio has been outperforming more and more. If you look back at our presentation last year, every period the core portfolio has gotten better and better because we've done a lot in the last 7 to 10 year period of build to core, adding to our separate accounts, and just growing those high conviction relationships. So our core portfolio has generally been on the upswing as of late, except for this 1-year period due to the strong performance of the REITs and the underweighting to it. Next slide, non-core performance. This one, there's a little bit more to this to peel back the onion. I think John said, and that was part of my talking points, is that things are bouncing back. There was a lot of write-downs taken last year by managers. You know, when the storm hit last year, our managers, there was no transactions in the market. There's not a whole lot to base on what they should do, but people felt like, just feels like we should be taking write-downs, and write-downs were taken. NOI was down a little bit, but write-downs were taken based on, in some cases, lack of transparency to what the actual value of real estate really was. So with the lag effect from the markets, the public markets tanking in March, April, the next couple of quarters, we saw our managers taking write-downs, but the reality is they thought there would be cap rate expansion, but in most asset class or most sectors of real estate, there's actually been cap rate compression over the last year for a variety of factors. So we're seeing that reverse of the marks, and that's coming in now and next quarter. And I think 2021 is going to be a much better year for valuation, simply because of some of that knee-jerk reaction of write-downs being reversed. There's certainly asset classes that are challenged and will continue to be challenged, but I think that's a big part of what is driving the 2021 or the last 12-year performance, 12-month performance. Ran some analysis this morning on another part of this. As this non-core portfolio ages, and we talked about this a little bit last year, as our non-core portfolio ages, and we haven't made a whole lot of commitments to it over the last 5 years, more and more of our portfolio is becoming tail positions. And by a tail position, I would define that as an investment that's either 10 plus years old at this point, the vintage year is 10 plus years old, or the value of the current value of the fund is less than 10% of what the original commitment was. So it's funds that are at the end of their life for one reason or another. Either they've sold a bunch of assets or they're just at the end of their life. And you can have a great fund since inception performance has done really well, but generally as they get towards the end of their life, there's a higher concentration of challenged assets in that fund because they're appropriately trying to turn them around and make something out of them. And in some cases, you know, what's left isn't really going to move the needle on an otherwise good fund. But when a downturn happens, those are the assets that were challenged to begin with that are going to get hurt the most. So we ran some analysis this morning to look at, there's 67 line items in our non-core portfolio, 67 different investment funds, whatever. And of those, 42 of them, as I defined earlier, would be tail positions. And if you look at the 1 year performance of, and collectively that's it's a little over 500 million, 501 million out of a total of $3 billion. So even though the count is high, 42 out of 67, it's only 500 million out of 3 billion. But the underperformance of those tail positions in the 1 year period underperformed the non-tail positions by 1,100 basis points. So a big difference. And again, it's not to say that every single one of those tail positions are bad investments. It's just as they get later in the life of the fund, there's a higher concentration of challenged assets. And those challenged assets, if it's a challenged asset before a downturn, it's going to be a bad outcome generally. Quite a few hotels that were challenged going into what happened last year have just been completely written off in various funds and impacted performance. One of the things later in my presentation, we talk about investment strategy objectives is secondary sales. And you know, that's something we've yet to do in the whole time I've been here is sell anything on the secondary market. We looked at doing that back in probably 2014. There was a process put in place and we just never executed on it at that time. And we did some analysis looking back on that last year, and you know, we could have taken a big discount off of these tail positions that we wanted to sell back in 2014 and been better off 5 years later. even if we had taken a big discount on them. As these funds get later in their life and there's a higher concentration of challenged assets that they're trying to turn around, you know, I think we should start taking a look at selling some of these assets, these funds, and just ripping the Band-Aid off and be done with them, taking our capital even at a discount and moving on and putting them in with our high conviction managers that we believe will do well going forward. Does that make sense? Slide 12. This is our unfunded commitment by vintage year, a very colorful chart. We've got about $1.2 billion of unfunded commitments left. But of that, we only think about 450 million of it will actually ever be called. 750 million will likely be held as reserves and just simply never be called. If you make a $100 million commitment to a fund, on average, most funds are reserving about 8%. That just generally never gets called unless something really bad goes wrong and they have to call it to try to save assets. But on average, about 8% just never gets called. And of the 1.2, we expect about 450 to be called, 300 million or so this year, and then the rest kind of dragging out over the next few years, assuming no new commitments. Next slide, slide 13, investment strategy and objectives. This really hasn't changed at all from last year, and I think consistency is key. We want to continue to focus on our high conviction managers. That helps us minimize cost, maximize return, and focusing on alignment of interest. We want to increase our exposure to public equities. As I mentioned, we were underweight what our policy target is, and I'd like to get that up actually to even an overweight position. One thing that we don't do at all is preferred equities, and I think preferreds are a good opportunity. Completion portfolio concept, we have 750 million in REITs, but I'd like to put more money in REITs and put it into what we call alternative REITs. We have a lot of exposure to the main food groups, you know, office, retail, industrial, multifamily. We have very little exposure to things like data centers, cell towers, even student housing, senior housing. And it's hard to get that exposure. We generally, our bite size is generally $100 million. And some of these sectors like self-storage, manufactured housing, they're very small check sizes. So it's hard to build up a portfolio of these types of assets that's diversified enough in the private sector. So we've contemplated this completion portfolio concept in the public sectors, trying to get that exposure to all those alternative real estate sectors through the public markets instead. And maybe in time we'll find managers that we want to build up relationships with and allocate a large amount of money to in these alternatives. But taking on a new manager is a challenge, and we generally only want to take on a new manager if we think we can grow the relationship to a considerable size. And I don't necessarily want 500 million of student housing or 500 million of data centers, manufactured housing. All those are good asset classes, but I don't know that I want $500 million of any one of those sectors. Secondaries, I mentioned earlier. We want to increase our exposure to the high growth sectors and increase our exposure to the low CapEx sectors. CapEx and fees obviously are a big driver of total return. Office has high CapEx spend. Retail has high CapEx spend. Hotel, high CapEx spend. But other sectors, industrial, multifamily, self-storage, manufacturer, they all have much, much lower CapEx spend. And if you can just reduce and focus your investments in sectors with much lower CapEx spend, it's easier to meet your return targets. That and obviously fees. If you invest with managers with lower fees, all things being equal, of course, we know that things aren't always all things equal, but fees drive performance, so does CapEx. I wanted to skip through and to the total performance pages, page 16, page 17. This slide on page 16 as of 12/31. This slide last year, just gonna hold it up. Last year, our 12/31/19 performance, this is what we really shoot for. Every year, 1, 3, 5, 7, 10, all 10 to 11% return. We've taken the hit this year in the short term because the 1-year performance has been challenged, but that's where we want to be. We want to produce consistent 10 to 11% returns over time. I believe this is going to revert. I think performance is going to be strong this year and next year, and we're going to get back to that consistent 10 to 11% return for every time period. Next page on 17. This just shows the incredible performance in the last year for REITs. Very quickly, slide 18. Leverage still remains low. It's ticked up a little bit from last year. Total real estate, I think, was 42 or 43% last year. It's 46% now. Total core real estate was 40% leverage last year. It's 42% this year. So still right in the range of where we want to be, but just up slightly from last year. And one more slide, slide 19. Just talking about diversification. We want more industrial. We want less retail. We're okay at office. We're okay on residential. You know, our positioning on just industrial, for example, last year we were 12%, I think. We're 14.9% this year. So that's going up, but the benchmark is going up a lot. It was 17% last year, and now the benchmark is 20% for industrial. So that spread for us, for industrial, even though we've gone up almost 300 basis points, that spread has even grown on industrial. And talk very fast, but I'd love to have questions. Greg, John, ask me questions. I'm going to defer them to John, but ask me questions.
I don't have any, but thank you.
Any other questions? Thank you both. Appreciate it. Thanks, sir. We'll now have a brief explanation from our Ben Garner about our ethics policy, and then we will have our meeting open to the public.
Thank you. As the treasurer said, we'll keep it brief. So Ben Garner, general counsel for the department and also counsel for the investment advisory committee. We do this annual review and annual recertification every year. This will be brief since this isn't the first or the second or third time you've seen or heard or read this. And I believe Gail sent these policies already to you. So quick review, quick summary. I think a couple of highlights. First is just to note that the key principle undergirding this code of ethics is that IC members should not advance personal or engage in behavior that appears to be a conflict of interest. So that's the basic ethical principle. Probably one of the most important things to highlight would be the definition of interested party. So that includes IC members, but then also IC member spouses, and then also partnerships or corporations in which you have a 10% interest. So if you look at the restrictions on page 2 of the Code of Ethics, there are 2 general categories. There's prohibitions related to interested parties. Then there's also prohibitions related to IC members individually. I won't go over those exhaustively, but probably the key thing to note is that there's no engagement, the prohibition on engagement in transactions where there's an interested party. So that's pretty straightforward. I'll mention also the disclosure requirement. There's 2 parts to that. There's a disclosure requirement both personally, if there's a situation you think arises where there's a conflict of interest. There's also a disclosure requirement if you're aware of another IC member or even department staff. If you're aware of misconduct or a violation of law, then you need to let me know.
Watching you.
Moving quickly, so the certification I think is in front of you, and for those of you IC members who've called in, That certification will be sent to you via DocuSign like we did last year. So there's also a applicable time period. That looks back to the last time you signed the form. So if you don't remember that date, we will complete that. We have your forms from last year. In the slide deck for your reference, we also included a list of applicable policies, updated policies. And one thing I will note is that we recently had Aon, we talked about this at a prior IC meeting. Aon did an independent review of our compliance and ethics regime. And I'll just note that we got very high marks for our efforts, and especially for our ethics approach. I will gladly take questions, but I don't want to be in the way of. If you have a particular question, feel free to email me or give me a call. And I will take your certifications when the meeting is over.
Any questions?
No, sir.
Good. We'll now go to, before we go around the horn, to the public comment period. Is anybody signed for public comment?
Yes, sir, one person.
Okay. The name is?
Kim Mackey.
Okay. Mr. Mrs.
I'm on, sir.
Kim Mackey, welcome to the Investment Advisory Committee meeting. This is Treasurer Falwell. You have the floor for 3 minutes, and you may proceed.
Okay. Thank you. Good morning. Can you all hear me?
Yes.
Okay. My name is Kim Mackey. I'm a public school teacher and likely the only one in this meeting who paid $50 to attend since I took a personal day. So the treasurer and I have something in common with concerns about fees. As a civics, economics, and personal finance teacher, it's my job to translate jargon into something meaningful for the high school seniors I teach. To that end, I have a 3-part question. My question pertains to what this presentation calls the selection and allocation effects over the time periods that align with Treasurer Falwell's tenure in office. As the sole fiduciary of the fund, I understand Treasurer Falwell to be accountable for asset allocation and the allocation effect, which, as acknowledged in this meeting, is quite negative, particularly when compared to the selection effect, and largely the result of cash holdings. It's difficult to see the full picture of that performance because everything is reported in basis points rather than dollars. So here's my 3-part question. First, how much money in total dollars has asset allocation choices cost those who educate, protect, and serve by the Treasurer's decisions over the past 1, 3, and 5 years? It was mentioned earlier in the meeting that the portfolio didn't lose $15 billion, it's down $15 billion, which seems to be a semantic distinction without much difference for how it affects pension stakeholders like me. Second, how much funded status in percentage point terms have we lost because of these missed opportunities? Third, given this impact on funded status, is the plan for paying pensions over the long term to withhold more money from our paychecks, assess higher contributions on the state and local governments who employ us, raise taxes, take on a lot more investment risk later, cut pension benefits, continue to deny cost of living adjustments to current retirees, or remove the pension benefit for future hires, as was done earlier this year for the state health plan? I want to be sure I'm not holding my students more accountable for their understanding and implementation of wise financial practices, nor myself more accountable for presenting information in a user-friendly manner than I'm willing to hold the state treasurer, who as sole fiduciary, the buck stops with him, and he carries the responsibility and trust for the pension plan serving North Carolinians who educate, protect, and serve. Thank you.
Thank you for your comments. We now deem the public sector, public comment section closed, and see if any board members would like to respond as we adjourn.
Just respond in general to the meeting. It's great to see everybody. I almost feel like with John's presentation, I need to not accept my per diem. Good meeting and good to see everybody.
I just echo that. Happy to see everybody and doing what you're doing. You're on the right path.
Mike?
Well, just as always, I'm so impressed by your staff and the way that they present themselves and the material. And thank you for all you guys do to prepare for these meetings.
And Lance?
Yeah, Treasurer, very well done today. Thoroughly impressed by John's presentation. It's just great to have some common sense approach to some of these strategies, and kudos to you and your staff for keeping the trains running, and look forward to seeing everybody next meeting.
Thank you. Thank you all. Thank you, staff. As I have said publicly, this is not a place to politicize things. As I've commonly stated, there's no political money at the Treasurer's office. There's no gender money and there's no race money. It's all green. And we remain in the check delivery business. So in honor of Deputies Ward and Fox from Watauga County Sheriff's Department, I'll accept a motion to adjourn.
So moved. Second. John Anarelli.
Any further discussion? If not, all's in favor, say aye.
Aye.
We're adjourned. Thank you very much.
Thank you, everybody.
And we'll do one back. Go ahead and hang up on the go-to, and that'll kill it.
No problem.
Thank you.
Right, thanks so much.
Let me get that dramatic.
Good to see you, sir.
See you too.
What are you saying?
For this helicopter amount.